The hearing will now come to order. Welcome, Chairman Powell, for your first appearance before this committee as Chairman of the Federal Reserve Board of Governors. Congratulations on your confirmation. Today's hearing is an important opportunity to examine the current state of monetary and regulatory policy. Over the past few years, the Humphrey Hawkins hearing has often served as an opportunity for members of this committee to review the new regulations imposed in the wake of the financial crisis. While I did not always agree with former Chairman Bernanke and former Chair Yellen, I appreciated their willingness to engage with the committee and to discuss possible improvements to the regulatory regime. These discussions were helpful in building a common ground for our banking bill, Senate Bill 2155, particularly for provisions like the threshold for enhanced standards under Section 165 of Dodd-Frank. This bipartisan bill now has 13 Republican and 13 Democrat independent co-sponsors. The bill was the result of a thoughtful, deliberative process over several years that included hearings, briefings, meetings, and written submissions from hundreds of commentators and stakeholders. The primary purpose of the bill is to make targeted changes to simplify and improve the regulatory regime for community banks, credit unions, mid-sized banks, and regional banks to promote economic growth. Economic growth has been a key priority for this committee and this administration and for this Congress. The U.S. economy has failed to grow by more than 3% annually for more than a decade, by far the longest stretch since GDP has been officially calculated. But now there are widespread expectations that growth is finally picking up. According to the January FOMC meeting minutes, the Federal Reserve increased its expectations for real GDP growth going forward after the fourth quarter growth exceeded expectations. The Fed cited the recently enacted tax reform legislation as among the reasons economic growth is expected to rise. In addition to tax reform, President Trump's recently released budget and economic report both emphasize that regulatory reform is a key component of rising productivity, wages, and economic growth. By right-sizing regulation, the committee's economic growth bill will improve access to capital for consumers and small businesses that help drive our economy. Now that many are predicting a pickup in growth, a number of commentators have expressed sudden concerns about the economy overheating. While the Federal Reserve should remain vigilant in monitoring inflation risks, we must also continue to pursue common-sense, pro-growth policies that will lead to increased innovation, productivity, and wages. With respect to monetary policy, I'm encouraged that the Federal Reserve is continuing on its gradual path to monetary policy normalization. The Fed has begun to reduce its balance sheet by steadily decreasing the amount of principal that it reinvests as assets in its portfolio as its portfolio matures. I look forward to hearing more about the Fed's monetary policy outlook as part of Chairman Powell's testimony today. I also look forward to hearing about the Federal Reserve's ongoing efforts to review, improve, and tailor existing regulations. I know that you are working with Vice Chairman for Supervision, Randy Quarles, on all of those issues, Mr. Chairman. Vice Chairman Quarles has done an excellent job so far, and I urge Congress to confirm him for his full term on the board as soon as possible. With that, Senator Brown.
Thank you, Mr. Chairman, and welcome to your first one of these. Mr. Chair, nice to see you. Welcome back to the committee. You're leading the Federal Reserve at a crucial time in our nation's history as the Fed normalizes interest rates and shrinks the balance sheet. The country is in its 9th year of economic recovery, though, as we know, 2017 marked the worst year for job creation since 2010. The recovery has not reached everyone. Wage growth has been slow. Labor force participation has barely improved since 2014. 9 years of job growth have still not done much to narrow income inequality or address employment disparities. Nationwide, the unemployment rate for African American workers is double that for white workers, equal to the gap at the start of the civil rights movement. Looking more broadly, labor force participation is down for all minorities. Statistics show that large pockets of people are waiting to share in the benefits from the recovery. Instead of addressing these problems and their problems, Republicans are working hard to make sure that Wall Street banks rake in even bigger profits. Despite the fact we're 9 years removed from the recession, the administration has embarked on a substantial fiscal stimulus, permanently slashing the corporate tax rate, providing the largest benefits to the wealthiest Americans over time. 81% of the benefits of that tax cut goes to the wealthiest 1%. Of course, Wall Street, which is making record profits, will do well. Instead of fighting for workers and making sure labor market opportunities are shared among those who have been struggling, Republicans push for tax cuts for corporations and the wealthy. Those tax cuts are not free. As you know, Mr. Chairman, they will add over $1 trillion to the deficit. The once and future deficit hawks on the other side of the aisle were more like marshmallow peeps when confronted with tax cuts for the wealthy. The ink was barely dry when we began to hear calls for spending cuts that will hurt families across the country. 81% of the benefits going to the wealthiest 1%. Then, alas, there's a budget deficit we have to address. Let's look at entitlement reform, quote unquote, that everyone should understand means cuts to Medicare, Medicaid, Social Security. It's the same playbook we've seen for years. The claim was that it would benefit, it would all be worth it because workers would benefit. I'm happy for any Ohioan who gets a bonus or a raise, but we've seen how banks and corporations have responded to the tax cuts, and the numbers are staggering. In January, Wells Fargo, they've been in front of this committee a number of times, and we've spent lots of times working on talking about their illegal behavior. Wells Fargo in January announced a $22 billion stock buyback, 288 times what it will spend on pay raises for workers. A lot of discussion, a lot of news coverage on the benefits to workers, on the bonuses or the pay raises, but 288 times that number went to stock buybacks for executives. Companies this year will start disclosing CEO to worker pay ratios as required under the Wall Street Reform Act. Honeywell announced an $8 billion stock buyback in December, just disclosed that as CEO it's getting a 61% pay raise. He makes 333 times the average worker's pay. It's pretty simple. For each pay raise or bonus for workers, companies are spending 100, 150, 200 times as much on stock buybacks and executive compensation. And it gets worse. While the biggest banks lavish pay raises and stock giveaways on their executives, they continue to violate the law and abuse their customers. The Federal Reserve recently imposed an unprecedented, if belated, penalty on Wells Fargo following several scandals, including the opening of millions of fake accounts and improperly charging borrowers, even after that scandal was disclosed, charging borrowers for auto insurance they didn't need. The Fed told Wells Fargo it can't grow until it's demonstrated that it's improved board oversight and risk management. It sounds like the Fed has come to the conclusion many of us in this committee reached a year and a half ago. Wells Fargo, simply put, is too big to manage. I'll be closely watching to make sure the new team at the Fed doesn't lift these penalties as the Consumer Bureau did without the bank making real changes. It's not just Wells Fargo. Last week, Citigroup announced it illegally overcharged 2 million credit card accounts for over 5 years. It'll refund $335 million to consumers. The Wall Street can't seem to go a month without a new scandal. The Senate is set to take up a bill that would roll back critical financial stability protections and limit watchdogs' ability to police the largest banks. We can expect the banks to spend any savings from less oversight the way they spend their tax cuts, more dividends, share buybacks, and mergers. Many of us in this body are concerned about this deregulation bill that I mentioned a moment ago, especially when it comes to foreign banks, those banks that are huge, but their assets in this country are under $250 billion. They're both troubled and troubling banks in their international operations, yet Secretary Mnuchin sat at that table and said he plans to deregulate some of these banks like Deutsche Bank and Santander, and we know the fines that they've paid and the problems that they have caused internationally. Chair Powell, Wall Street may be focused on whether there are 3 or 4 rate hikes this year. I think your focus needs to be on ensuring the Fed doesn't once again permit the buildup of risk in the market and hubris at the Fed. The great moderation turned out to be not so great. We forget that lesson at our peril. The Fed needs to take the side of consumers, making sure the financial system stays strong and regulations are enforced. Look forward to your testimony.
Thank you very much. And Chairman Powell, once again, we appreciate you being here. We look forward to your opening statement, and you may proceed.
Thank you very much, Chairman Crapo, Ranking Member Brown, members of the committee. I'm pleased to present the Federal Reserve's semi-annual monetary policy report to Congress today. On the occasion of my first appearance before this committee as Chairman of the Federal Reserve, I want to express my appreciation for my predecessor, Janet Yellen, and her important contributions. During her term as chair, the economy continued to strengthen, and Federal Reserve policymakers began to normalize both the level of interest rates and the size of the balance sheet. Together, Chair Yellen and I have worked to ensure a smooth leadership transition and provide for continuity in monetary policy. I also want to express my appreciation for my colleagues on the Federal Open Market Committee, and finally, I want to affirm my continued support for the objectives assigned to us by Congress, maximum employment and price stability, and for transparency about the Federal Reserve's policies and programs. Transparency is the foundation of our accountability, and I'm committed to clearly explaining what we're doing and why we're doing it. Today, I will briefly discuss the current economic situation and outlook before turning to monetary policy. The U.S. economy grew at a solid pace over the second half of 2017 and into this year. Monthly job gains averaged 179,000 from July through December, and payrolls rose an additional 200,000 in January. This pace of job growth was sufficient to push the unemployment rate down to 4.1%, about 0.75 of a percentage point lower than a year earlier, and the lowest level since December of 2000. In addition, the labor force participation rate remained roughly unchanged on net, as it has for the past several years. And that is a sign of job market strength, given that retiring baby boomers are putting downward pressure on the participation rate. Strong job gains in recent years have led to widespread reductions in unemployment across the income spectrum and for all major demographic groups. For example, the unemployment rate for adults without a high school education has fallen from about 15% in 2009 to 5.5% in January of this year, while the jobless rate for those with a college degree has moved down from 5% to 2% over the same period. In addition, unemployment rates for African Americans and Hispanics are now at or below rates seen before the recession, although still significantly above the rate for whites. Wages have continued to grow moderately, with a modest acceleration in some measures, although the extent of the pickup likely has been held back in part by the weak pace of productivity growth in recent years. Turning from the labor market to production, inflation-adjusted GDP rose at an annual rate of 2.8% in the second half of 2017, nearly a full percentage point faster than its pace in the first half of the year. Economic growth in the second half was led by solid gains in consumer spending, supported by rising household incomes and wealth and upbeat sentiment. In addition, growth in business investment stepped up sharply last year, which should support higher productivity growth in time. The housing market has continued to improve slowly. Economic activity abroad has also been solid in recent quarters, and the associated strengthening in the demand for U.S. exports has provided considerable support to our manufacturing industry. Against this backdrop of solid growth and a strong labor market, inflation has been low and stable. In fact, inflation has continued to run below the 2% rate that the FOMC judges to be most consistent over the longer run with our congressional mandate. Overall consumer prices, as measured by the Price Index for Personal Consumption Expenditures, or PCE as we call it, increased 1.7% in the 12 months ending in December, about the same as 2016. The core PCE price index, which excludes the prices of energy and food items and is a better indicator of future inflation, rose 1.5% over the same period, somewhat less than in the previous year. And we continue to view that some of the shortfall in inflation last year was likely reflecting transitory influences that we do not expect will repeat. And consistent with this view, the monthly readings were a little bit higher at the end of the year than in earlier months. After easing substantially in 2017, financial conditions in the United States have reversed a bit of that easing, And at this point, we do not see these developments as weighing heavily on the outlook for economic activity, the labor markets, and inflation. Indeed, the economic outlook remains strong. A robust job market should continue to support growth in household incomes and consumer spending. Solid economic growth among our trading partners should lead to further gains in U.S. exports, and upbeat business sentiment and strong sales will likely continue to boost business investment. Moreover, fiscal policy has become more stimulative. In this environment, we anticipate that inflation on a 12-month basis will move up this year and stabilize around the FOMC's 2% objective over the medium term. Wages should increase at a faster pace as well. The committee views the near-term risks to the economic outlook as roughly balanced, but will continue to monitor inflation developments closely. I will turn now to monetary policy. The Congress has assigned us the goals of promoting maximum employment and stable prices. Over the second half of 2017, the FOMC continued to gradually reduce monetary policy accommodation. Specifically, we raised the target rate for the federal funds rate by a 1/4 percentage point at our December meeting, bringing that target rate to a range of 1.25% to 1.5%. In addition, in October, we initiated a balance sheet normalization program to gradually reduce our securities holdings. That program has been proceeding smoothly. These interest rate and balance sheet actions reflect the committee's view that gradually reducing monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%. Engaging the appropriate path for monetary policy over the next few years, the FOMC will continue to try to strike a balance between avoiding an overheated economy and bringing PCE price inflation to 2% on a sustained basis. While many factors shape the economic outlook, some of the headwinds the U.S. economy faced in previous years have turned into tailwinds. In particular, fiscal policy has become more stimulative, and foreign demand for U.S. exports is on a firmer trajectory. Despite the recent volatility, financial conditions remain accommodative. At the same time, inflation remains below our 2% longer-run objective. In the FOMC's view, further gradual increases in the federal funds rate will best promote attainment of both of our objectives. As always, the path of monetary policy will depend on the economic outlook as informed by incoming data. In evaluating the stance of monetary policy, the FOMC routinely consults monetary policy rules that connect prescriptions for the policy rate with variables associated with our mandated objectives. Personally, I find these prescriptions helpful. Careful judgments are required about the measurement of the variables used, as well as about the implications of the many issues these rules do not take into account. And I would note that this monetary policy report provides further discussion of monetary policy rules and their role in our policy process, extending the analysis we introduced in July. Thank you again. I look forward to our discussion.
Thank you, Mr. Chairman. I'm going to focus my questions on Senate Bill 2155, which I referenced in my introductory remarks. But first, Mr. Chairman, you are familiar with that legislation, correct?
Yes, I am.
In past hearings, former Chair Yellen, former Federal Reserve Governor Tarullo, and former Comptroller of the Currency, among others, have all expressed support for changing the $50 billion threshold for enhanced prudential standards. Building on that feedback, Senate Bill 2155 raises the threshold from $50 billion to $250 billion and requires the Fed to tailor regulations to a bank's business model and risk profile. I'd like to ask you some questions about this bill if it does become law. And there's 5 or 6 of them, so I'd like to have you respond as briefly as you can, but fully answer the questions. Is it accurate that the Federal Reserve would still be required to conduct a supervisory stress test for any bank with total assets between $100 billion and $250 billion to ensure that it has enough capital to weather economic downturns?
Yes, it is.
And is it accurate that the Federal Reserve would still have sufficient authority to apply any prudential standard to a bank with between $100 billion and $250 billion in total assets if the Fed determined that was appropriate?
Yes, that is true.
Is it accurate that this provision does not weaken oversight of the largest globally systemic banks?
That is correct.
is it accurate that the Federal Reserve applies enhanced standards to international banks based on their global total consolidated assets, meaning this provision would not exempt banks such as Deutsche Bank and Santander from Section 165 of Dodd-Frank?
That is correct.
Is it accurate that this provision does not in any way restrict the Fed's supervisory, regulatory, and enforcement authorities to ensure the safety and soundness of financial institutions?
Yes, yes.
And finally, is it accurate that nothing in this provision would restrict the Fed's ability to ensure that large financial institutions are well capitalized?
Yes.
Thank you. And to go on a little bit, as you know, the Dodd-Frank Act included a provision known as the Volcker Rule, which placed restrictions on banks that trade for their own profit, otherwise known as proprietary trading, and on certain relationships with certain private funds. As you also know, financial companies have incurred significant costs attempting to comply with the rule. Do you support addressing this confusion by exempting community banks with less than $10 billion in total assets and who are engaged in a small amount of trading activity?
I think that is a sensible thing to do, yes.
All right, thank you. And some have expressed concerns that this exemption would allow a community bank to purchase a hedge fund. Is it accurate that the Federal Reserve could use its existing authority to address any safety and soundness concerns arising from such an action?
We would still apply all of our safety and soundness supervisory activities to that bank, and we would be looking for things like that and find them.
All right, thank you. Finally, and I'm shifting gears away from the legislation right now, I also mentioned in my opening statement that Randy Quarles has been confirmed as Vice Chairman for Supervision of the Federal Reserve, but has not been confirmed for his full term as a governor yet. I believe it's very critical that we do that confirmation and confirm Governor Quarles for his full term. Do you agree? And if you do, why is it critical for the Senate to confirm Vice Chairman Quarles as soon as possible?
Well, thank you for raising this, Senator, Mr. Chairman. I absolutely agree. It's very important that Vice Chair Quarles get his full term. So at this point, he's working on an expired underlying governor term, but he has a 4-year chair term, and I think to have him fully installed is very important that he have this underlying governor term. All right,
thank you. I appreciate your emphasis on that, and hopefully that will help to encourage the Senate, the full Senate, to move more expeditiously on that nomination. Senator Brown.
Thank you. I appreciate my friend and colleague, Chairman Crapo's skillful narrow and leading questions about his legislation. I think it's important to point out that the question particularly about foreign banks, the Deutsche Bank and Santander, and those banks that have been both troubled and troubling will be mostly deregulated under this bill because they're under 250. That's not really my question. I want to get to questions. But I also want to point out, in spite of this chair of the Federal Reserve, general satisfaction with this bill, that there have been serious questions raised about it by former Fed Chair Volcker, by former Fed Governor and Deputy Treasurer Secretary Sarah Bloom Raskin, by Bush appointee, former FDIC Chair Sheila Bair, by former Consular of the Treasury Secretary Antonio Weiss, and by the former Deputy Governor of the Bank of England, Paul Tucker. I think it's important to note that it's not all candy and roses here. Let me talk about a couple other things. Unemployment rate's been steady at 4%, 4.1%. Wage growth, as you know, Mr. Chair, has been slow to improve. At your confirmation hearing in November, you mentioned that labor force participation for prime age workers was also lagging. I'd like to see improvement across the board, as I know you would. 2 questions related to that. Do you think it's possible to achieve further improvement in wages and employment among workers that have been left behind without causing higher inflation? And will you commit to looking at all the data and considering the workers who have struggled the most so as to avoid raising rates preemptively and cutting off the chances for broader economic gains?
Thank you, Senator. So, as you mentioned, there are a couple places where it looks like there may be additional slack in the labor force, and the biggest of those is that prime age participation by prime-age workers is a full percentage point below where it was before the crisis. We don't see any strong evidence yet of a decisive move up in wages. We see wages by a couple of measures trending up a little bit, but most of them continuing to grow at about 2.5%. So nothing in that suggests to me that wage inflation is at a point of acceleration, and so I would expect that some continued strengthening in the labor market can take place without causing inflation. We'll, of course, be monitoring that, and I think the risks are much more two-sided than they were 2 or 3 years ago when there was a great deal of slack in the labor market.
And I appreciate, as I told you in person, your interest and commitment to both mandates of inflation and employment. One Fed nominee that's still in abeyance may not have the votes on the floor, doesn't take that position. Your position there is crucial, as Chair Yellen understood, as Chairman Bernanke understood. Second question, Morgan Stanley and other Wall Street analysts have said that only 13% of the reduced taxes under the tax bill being paid by companies will go to workers' pay, 18% will go to mergers. If that ratio holds up for banks, 18% will go to mergers, 13% for worker pay. If that ratio holds up for banks, whether it's the tax bill or the chairman's bill he talked about, shouldn't we expect even more bank consolidation?
First, I'd say we don't really know yet how that will shake out. But taking your hypothetical, would it add to more consolidation among the banks? Bank consolidation has been going on for 30-plus years. It's got a lot to do with smaller banks and economic activity moving out of the rural areas into the city and interstate banking and things like that. I'm not sure this would tend to change the trend.
Yeah, I appreciate what you just said, because I certainly heard the deregulators in this body, those that suffer this collective amnesia about what happened a decade ago, always blaming bank consolidation on Dodd-Frank, when, as you point out, it's been going on for years. Mr. Chairman, here's an American Banker article from November that discusses your bill. The title is "SIFI Hike Could Kickstart Bank M&A," and I asked to enter that in the record.
Without objection.
Thank you. Last question. Most of the Wall Street, the big Wall Street bank offenders most of the Wall Street banks have been repeat offenders since the crisis. The Fed and other regulators have fined them. You were part of this. $243 billion in combined penalties, money laundering, market manipulation, deceiving customers, you name it. The chairman's bank deregulation bill would mandate that the Fed further tailor rules for the largest banks. Meanwhile, Vice Chair Quarles is talking about the Fed's plans to make living wills less frequent, to reduce leverage rules, to weaken the Volcker rule. Why should big banks that have consistently failed to follow the rules benefit from statutory or regulatory rollbacks?
I would just say that our focus is very much on the smaller and medium-sized banks. We want the post-crisis regulatory initiatives like higher capital, higher liquidity, stress testing, resolution. We want those to apply in their strongest form to the largest institutions. We want to make sure we're doing that efficiently, and there are some changes we can make in that regard. But most of what we're doing really applies to banks that you move down.
But I sat with Senator Crapo and a number of others that are in this room on the Finance Committee, and I heard Republican after Republican say the tax cut was all about the middle class, yet 81% of the benefits went to the wealthiest 1%. I heard you, and I hear the push for this S2 155 being all about the community banks, but we know much of it's driven by what happens for the larger banks, the weaker stress tests, the periodic stress tests, what we're doing instead of annual, what we're doing for the foreign banks. So I hear your talk about your interest primarily is the smaller banks, but I guess the question still stands. Why should anything in this bill, why should we do anything for the largest banks, as this bill does? Why should we do anything for banks that have consistently failed to follow the rules? Why should they benefit from statutory or regulatory rules rollback?
As I see the parts of the bill that I'm familiar with, they really apply to banks 250 and under. And I think when you say largest banks, I think you're talking about either the 8 SIFIs, by the way, one of which is below $250 billion in assets. So we're very capable of reaching below 250 to apply enhanced prudential standards when it's appropriate. But it's really those institutions that I would call the large and complex institutions, and the focus there, again, is on sustaining the four pillars that I mentioned of post-crisis regulation, and maybe looking at making them more efficient. They don't need to be more. They shouldn't be more burdensome than they need to be. But we're looking to strengthen and hold on to those.
Well, I hope in your conversations with the Chair of Supervision, Mr. Quarles, that you will insist that this is about the banks under 250, and insist on that it's not about the banks over 250, as some on this podium have suggested. Thank you.
Thank you, Senator Shelby. And I do remind our colleagues that we need to stick to the 5-minute rule.
That's prospective, isn't it, Mr. Chairman? Chairman Powell, you referred to price stability just a few minutes ago as one of the mandates for the Fed in your job. Let's talk a little about price stability and unemployment being real low. Prices, you mentioned earlier that inflation is, I assume, under control, whatever that is. You know, you got your eyes and you got your hands on it, so to speak. And but a lot of people believe that you will continue to raise interest rates at incremental levels in the future. Is that because of your concern about the specter of inflation? That being full employment, so to speak, you know, mostly pressure on wages, or where's it coming from, in other words, or is it all of it?
Senator, so where we are now is we've got unemployment, as you know, at 4.1%, which is sort of at or near or even below most estimates of the natural rate of unemployment.
Absolutely.
But we have inflation that's still a little bit below. So by continuing to gradually raise interest rates over time, we're trying to balance those two things and achieve inflation moving up to target, but also make sure that the economy doesn't overheat. Now, there's not a lot of evidence there's no evidence that the economy is currently overheating, but that's really the path that we've been on, and my expectation is that will continue to be the appropriate path as long as the economy performs this way.
Well, I think that's a substantive path, too. I agree with you. Do you believe that there's going to be a push for higher wages? You know, you see a little of it now. The economy's good. People seem to be doing well. The tax cuts come in, which is probably going to help. We see that it's going to help at least confidence and everything in the economy. What do you see there?
It's interesting. Unemployment has declined from 10% at the worst part of the crisis, and actually well after the crisis, down to 4.1% now. And wages have only really gradually started to track up. The increases are now up at about 2.5% if you blend the various measures we look at. We look at a bunch of them. And I will be honest, I would have thought that you'd see more wage increases by this point. And I do expect that we will see more wage increases. We've got an economy with strong momentum. We've got strong job creation as a result of it. We've got low unemployment. And I do think you will begin to see wages coming up. But we've been feeling that way, and that's kind of what we're waiting to see. Hope we see it soon. Expect to see it.
How important to the economy and to the monetary policy is price stability?
Price stability is one of our two mandates. It's the very heart of what we do. Absolutely at the very heart of what we do.
Okay. I'd like to switch over to your other job, and that is dealing with regulatory issues. Cost-benefit analysis unit. It's my understanding that the Fed has announced recently its intention to create what they call a policy effectiveness and assessment unit to conduct cost-benefit analysis on regulations. If that's so, I applaud that effort. A lot of us on this committee have pushed that for years, believing that there should be a real cost-benefit analysis to every regulation. What's the status of this group's development, Mr. Chairman, and what do you hope that will come out of this?
As you know, Senator, we always try to implement regs in the regulations in the way that's least burdensome and also faithful to the intent of Congress. In this particular case, we're trying to raise our game here by having a specific group of quantitatively oriented people who are focusing just on that. We have lately published cost-benefit analysis on specific regulations like the SIFI surcharge, long-term debt, and things like that. So, you know, we're trying to raise our game here. By the way, whenever we go out for comment on a reg, we also ask for the public's views on costs and benefits. So it's really important to us, and as I said, as you pointed out, we're trying to raise our game.
A lot of it, though, is letting the public know what all of this is about and what the cost will be, and to them as well as to the economy, is it not?
It is, and that is our obligation, is to be transparent about those things.
Thank you. Thank you, Mr. Chairman.
Thank you. Senator Tester.
Yeah, thank you, Mr. Chairman and Ranking Member Brown. I appreciate you having this hearing, and welcome, Governor Powell. It's great to have you here. There has been a perception being floated by some that the largest foreign banking organizations, such as Barclays, UBS, Deutsche Bank's been talked about today already, will be released from enhanced prudential standards under the economic package brought forward called S-2155. I fundamentally disagree with that. I think it's those views are a myth, and certainly not the text that is in S-2155. But I'm a dirt farmer, okay? I just kind of read things as they are and don't read a lot of extra stuff into it. You're the man on the Fed, and so I need to know your opinion. Does 2155 require the Federal Reserve to weaken any of the Dodd-Frank enhanced prudential standards for the FBO, such as Deutsche Bank, UBS, or Barclays?
It does not, according to my reading of the text. Can
you elaborate briefly, if possible, on how those standards are applied to the largest FBOs?
Well, currently, what the bill does is it moves up to 250 for these institutions, but it looks at their global consolidated capital. So, you know, now we have intermediate holding company requirements for these companies, and none of those would be affected by this. And you know, what that means is that they're required to keep capital and liquidity here in the United States. It's commensurate with their activities. They're also subject to living wills and things like that. So, you know, it's a range of enhanced prudential standards. The intermediate holding company thing is an extra one that we gave them.
Okay. Thank you. I'm also frustrated that some are jumping to conclusions about how or what might happen regarding international holding company requirements. So just to clarify, from your perspective, the creation of the IHS was not included in Dodd-Frank, correct?
That's right. That was something that we added on independent of Dodd-Frank.
And the legislative language in S-2155, the bill that we've been talking about this morning a lot, does not require any change to the IHC, correct?
It does not.
Okay, thank you for clearing that up. Now, I asked you this question during your confirmation, right around the time that 2155 was released. It's been nearly 3 months, and that bill has made its way through this committee and has overwhelming bipartisan support, and hopefully we'll see the floor next week. And what I asked you at that juncture was, do you believe 2155 puts our financial system at risk? At that moment in time, you said no. So now you've had a little more time, get your feet on the ground. Do you continue to believe that?
I do.
Okay, lastly, go ahead.
I can elaborate if you want or
sure,
not.
Sure, have at it.
Okay. So, you know, the essence, probably the most significant piece of it is that you raised the threshold for enhanced prudential standards to 250, but you give us the ability to look below 250. We will publish a framework that addresses, and we'll put it out for comment, that addresses how we'll think about that. We have not been shy about reaching below 250. One of the 8 SIFIs, in fact, is below 250 billion in assets. So I think it gives us the tools that we need to continue to protect financial stability.
Thank you. Lastly, I think it's important for the folks to remember that the Federal Reserve and Chairman Powell have a number of tools in their toolbox when it comes to regulating our financial institutions, well beyond that, what we even created in Dodd-Frank. I think it's important to remember that things like advanced approaches, CCAR, Basel, weren't created by Dodd-Frank. And if I'm not mistaken, advanced approaches and CCAR were put in place during Republican administration. So I guess my question for you, Chairman Powell, is this. Can you remind folks what your safety and soundness authority means to the Federal Reserve and what that authority it gives to you?
It gives us broad authority to, you know, except in places where Congress has address particular areas. We have broad safety and soundness authority to do capital requirements and of various kinds, liquidity requirements and things like that, and look after the safety and soundness of all depository institutions.
Thank you. I just want to close with saying that I don't for a second think that Dodd-Frank was the only reason we're seeing consolidation in banking. I think technology plays a big role in that, and population shifting plays a big role in that. On this committee, I can deal with Dodd-Frank. Thank you, Mr. Chairman.
Thank you, Senator Corker.
Thank you. Welcome, Mr. Chairman. It's good to have you here, and congratulations on your confirmation. You talked about the accommodative fiscal policy that's in place right now, and just out of curiosity, I know there's people predict y'all are going to raise rates 4 times this year. You're definitely going to raise rates some. How much did the tax bill that was put in place, how much of that is affecting your desire to or your likelihood of raising rates over this year?
I wouldn't single it out, Senator. I would say
No. I'm not trying to single it out, but just out of curiosity, it is in fact something that is going to be stimulative. So, how much of a factor is it in looking at raising rates?
You know, fiscal policy is one of many factors. We're looking, as you know, we're looking at stable prices, maximum employment. That's what we're looking at, and everything that happens in the economy and financial conditions and fiscal policy affects that. We can't really isolate one thing, like fiscal policy. But I think, I would expect that fiscal policy this year is going to add meaningfully to demand, and that's going to put upward pressure on inflation and downward pressure on unemployment. It's hard to quantify, but it wouldn't be the main factor. I mean, the economy's strong, and it's even stronger now.
Yeah. So then, as it relates to growth, you said it was going to increase demand. How much of a factor is it in your growth projections, the passage of the tax legislation?
As I mentioned, I think it will add meaningfully to growth for at least the next couple of years. The real question is, how much will it add to, and the amount of that is subject to very different estimates by different approaches. But I guess the bigger question is how much will it add to longer run growth? And there are a couple of channels through which that might happen. Higher investment should lead to higher productivity, which would raise potential growth. Lower tax rates on individuals should increase labor supply. These are highly uncertain, but we hope the effects are meaningful there as well.
Mm-hmm. You know, we've been through a decade now, I guess, since the crisis, and many of us were here during that time. It was a pretty heady time trying to resolve those issues, and yet we went through periods of time when we were worried about deflation. Obviously, we had really accommodative monetary policy during that time, and here we are again at 4.1% employment, down from 10, as you mentioned. The economy's strong, and yet still, let's face it, I mean, 2% inflation. I know y'all are combating anything getting out of control. Elaborate on the factors that in this day and age, in this economy, in this world situation, what is it that is keeping inflation at such a low rate?
It's a global phenomenon, and we don't perfectly understand it, but I would say since the crisis, a big factor that's been weighing down on inflation has been just the weakness in the economy. You've had a lot of slack, and the economy has not been tight, and so that it makes sense that would press downward on inflation. We also had, the strong dollar and lower oil prices in 14 and 15. That pushed down. So more lately, we would have expected inflation to come up by a few more tenths than it has, and we see identifiable idiosyncratic factors. There are other stories, though. There's the Amazon effect story. There's global slack. The idea that slack around the world is affecting the tightness of the U.S. labor market. Really hard to tie those down from an empirical standpoint, but that may be having some sort of an effect on inflation as well. It is a global phenomenon, though, so it's not just tied to domestic factors.
So I know that my friends on the other side tend to focus a lot on the tax bill, and there's hope that growth is going to overcome any kind of deficits there. It may or may not occur, but we are, in fact, getting ready to spend $2 trillion more that we don't have by passing the bill we just passed. We've got an omnibus coming up over the next 10 years. It's a minimum of $2 trillion in additional spending, almost twice what the president requested, and we have $21 trillion in debt today. How much does the deficit picture for our country come into play relative to the Federal Reserve, and how concerning is it to you that we continue just to party like there's no time ending here in Congress?
We're not on a sustainable fiscal path. We need to get on one. This is a good time to be doing that when the economy is strong, but that's a longer run problem. It isn't really it's not a problem for today's monetary policy or economy. It becomes a problem gradually over time as we spend more and more of our expenditures on interest rate, on debt service, and we have less and less to do the things that we really need to do, and as we pass along bills to future generations. But it doesn't the unsustainability of our fiscal path isn't something that has too much of an effect in the near term on our policies.
Thank you, Mr. Chairman. Thank you.
Senator Menendez.
Thank you, Mr. Chairman. Welcome, Chairman Powell. Good to see you. I want to follow up on some questions that my colleague, Senator Brown Shelby, asked you about. Inflation is continuing to run below the Fed's 2% target, which has prompted a majority of regional Federal Reserve Bank presidents to urge a study of the current inflation framework. And while we have seen significant economic gains since the worst days of the recession, most hardworking families are still waiting to see their paychecks rise. Real median wages increased by only 14% from 1979 to 2017, and any recent acceleration in wages is accruing to high-paid executives and managers, with production and non-supervisory workers simply not seeing those gains. The Fed's projecting a minimum of 3 interest rate increases in 2018, and after your testimony on Tuesday, the markets are now anticipating as many as 4 hikes. Do you agree that the achievement of full employment should be associated with strong and broad-based wage growth for average workers, not just increases for executives and managerial pay?
I do, Senator.
And if so, doesn't that argue for consideration of a monetary policy path that would allow wages to continue to grow prior to the Fed's pumping the brakes?
I agree that it does, and I believe that is in fact the path we're on. These are gradual rate increases, and we do expect wages to move up.
What would the cost to the economy of overshooting inflation in the 2 to 3% range versus the cost to the economy of choking off growth if the Fed continues to tighten without a clear indication that inflation is going to exceed its target be?
Well, the risk, one of the risks we're trying to avoid, I think, as I mentioned earlier, the risks are more balanced than they used to be. For many years, it was clear there was a lot of slack in the economy, and I, for one, supported accommodative policy. At this point, we have 4.1% unemployment, and the thing we don't want to avoid we don't want to have happen is to get behind the curve, have inflation move up, and have to raise rates too quickly, cause a recession. And recessions, they hit the most vulnerable groups, the hardest. And so that's where unemployment goes up the fastest and that kind of thing. So to prolong the recovery, the committee's view is that we should continue on this gradual path of rate increases, which balances lower inflation and low wages against the need to make sure that we don't run too far past the natural rate of unemployment.
Mm-hmm. Well, I hope you'll continue to look at wage growth as part of your calibrations. Let me ask you this. During the confirmation hearing, I was pleased to vote for you. I asked you about the economic risks of adding an additional $1.5 trillion to the deficit. And I just heard your responses to my colleague from Tennessee that we're not on a sustainable path. We need to get one. Obviously, we weren't on a sustainable path before we added $1.5 trillion to the debt in the tax cuts that were generated. And you then said in response, and I quote, "I think we need to be concerned with fiscal sustainability over the long term." And in the same hearing, you agreed with Senator Van Hollen when he asked you said adding $1.5 trillion to the deficit would make a bad situation worse. Now, Your predecessor previously testified before this committee when she said, quote, "I'm personally concerned about the U.S. debt situation. Taking what is already a significant problem and making it worse is a concern to me." Do you agree with former Chairman Yellen that there's reason to be concerned about mounting deficits and growing national debt?
I do, and I'll follow what my predecessors have done and not get too much into the details of fiscal policy, but I will say a couple of things. One is, as I mentioned, we need to get on a sustainable fiscal path in the longer run. We know that we're not in the longer run. The second thing is when we do fiscal policy, when you do fiscal policy, I think it's important to keep in mind measures that would increase the productive capacity of the United States, of the economy, things that would increase productivity, that foster investment in people, in education and training, in R&D, and in plant and equipment as well. Those kinds of policies can help the whole economy grow faster on a sustainable basis.
I agree with you. It's just that stock buybacks don't quite do that. Let me ask you a last question. In January, the New York Federal Reserve Bank president said that tax legislation is likely to generate frictional costs that will mitigate its effects on growth, namely disparate impacts regionally. In particular, President Dudley was pointing out the gutting of the state and local income and property tax deduction, which would raise the cost of ownership and adversely affect prices and construction activity in states like New Jersey. Do you agree with President Dudley's analysis that states like New Jersey will see regional economic disparities as a result of the tax bill?
Senator, I hope you'll allow me to say that I'd rather not get into the particular details of any particular fiscal bill as chairman, and I think I'm happy to talk about things at a high level, but getting into commenting on particular sections in a fiscal bill, which is not our responsibility for me, is probably not a good idea.
Your president of the New York Reserve made that observation, so I would hope that we would look at the consequences to regional growth as part of your overall growth path. The region that I'm from generates nearly 20 to 25% of GDP for the entire nation. If we're going to have policies that ultimately affect the ability to be that engine for part of economic growth of the country, we should be considering that as well. Thank you, Mr. Chairman.
Senator Cotton.
Thank you, Mr. Chairman, and Mr. Powell, welcome as your first appearance as chairman. First of many. I'm sure you have them all circled in your calendar. Look forward to the eagerness as a child does to Christmas, right?
Indeed.
I want to talk about the labor market, in particular wage growth for America's workers. An article in the Harvard Business Review last October discussed wage trends since the 1970s and found that wage gains have mostly accrued to top earners, while wages have declined or been stagnant for the bottom half of the income distribution. The bottom half of the income distribution is comprised of many Americans who don't have a four-year degree, many who don't even have a high school diploma. Research from the Economic Policy Institute shows that American workers without a high school education have seen their wages decline by 17% since 1979, adjusted for inflation. And for workers with a high school education but no college, wages have declined by 2%. The chart to my left displays this, shows what I'm talking about. You can see the massive wage growth for those with a college degree or an advanced degree, and wage declines in real terms for those with a high school degree or less. One of my top priorities is to ensure that hardworking Arkansans can share in the economic prosperity that we see in our country in ways that they have not over the course of my lifetime. Mr. Chairman, you write, I should say the entire board writes on page 2 and 3 of the Monetary Policy Report, although there is no way to know with precision, the labor market appears to be near or a little beyond full employment at present. What's your personal assessment of this matter? Is the economy at full employment today?
You know, as we say in our statement of longer run goals and policy strategy, we look at a number of, there's no place you can directly observe it, so we look at a range of indicators, and I would say most of those indicators say that we're either at or beyond full employment. There are a couple that suggest maybe we're not. I would point to wages, and I would point to labor force participation by prime age males. This is a long answer. It's hard to give a really clear answer, but we don't actually know precisely where full employment is. Put it all in the blender, it seems to me we're very close to full employment.
Yeah,
but
pick up on your...
I would add, that isn't the case in every region, or, you know.
To pick up on your point about labor force participation, while our unemployment rate is a bit of good news at 4.1% and jobless claims seem to be continuing to trend downward, it is somewhat surprising, given those economic conditions, that over the last year, labor force participation continued to decline from 62.9% in January of 2017 to 62.7% in January of 2018. Even if you account for demographic change, for the aging of the baby boom generation, many estimates say that 2 million workers are still missing from our economy. I also would note that job growth continues to exceed population growth, which suggests that there's still slack in the labor market. And a lot of this slack appears to be, in part, on the lower end of the economic scale of those workers who have a high school degree or less than that. Would you agree with that assessment?
Generally, yes. We are, labor force participation has been essentially flat since the back half of 2013, so a little more than 4 years, and the downward trend might be 25 basis points a year. So I look at us as having made up probably the slack that emerged, fully made up the slack that emerged as part of the crisis.
And the wage growth we've seen over the last year, while good, I would suggest it's still not good enough, especially as long as we have those missing workers. So I'd hate to see, putting aside all the other reasons why you might see rate increases in the coming months ahead, rate increases because of continued increases in wages, especially for working class Americans. And the labor market, like any other market, is a market that's driven by supply and demand, correct?
Yes.
So if the supply of labor exceeds the demand of labor, then you'd see downward pressure on wages. That's one reason why I and some other senators, like Senator Perdue, have been so focused on our immigration system. If you could magically convert 1 million high school graduates in this country to 1 million Stanford graduates that could go to work in our high-tech industry, then presumably that would be good for the wages of working-class Americans. Well, that's essentially what we do every single year, is that in reverse, is we bring in 1 million unskilled and low-skilled workers that are competing against the very people who have not shared in prosperity, and for that matter, competing against the previous generation of immigrants. I don't think that's good for American citizens. I don't think that's good for our economy. And we'll continue to work hard to make sure that those workers can share in the prosperity that all Americans in the upper income brackets and college educated and more have shared in the past. Thank you.
Senator Schatz.
Thank you. Chairman, thank you for being here. Thank you for being willing to serve. I want to talk about student loan debt. There is currently $1.4 trillion in outstanding student loan debt, the highest category of consumer debt behind mortgages. It's also the most delinquent, with 11% of borrowers seriously delinquent or in default. The Fed estimates that this number is likely closer to 22% once you take into account the number of borrowers who are in forbearance. In contrast, at the height of the financial crisis, mortgage delinquency was just under 5%, and currently that rate is around 1%. According to the Federal Reserve's data, high levels of student debt have contributed to lower rates of homeownership and new business starts. And so, in your view, does the high level of student debt create a drag on the economy?
On student loan debt, I think it's important that people be able to borrow to make what may be the most important investment of their lives, which is in their education. So overall, I think borrowing to invest in yourself is something we should foster, subject to a couple of important caveats. First, it's very important that people understand the nature of the borrowing and the risk that they're taking and the possible payoffs and that sort of thing, so that they make informed decisions. The second thing is, I think alone among all kinds of debt, we don't allow student loan debt to be discharged in bankruptcy.
Right.
I'd be at a loss to explain why that should be the case. So it's something, and this is fiscal policy, this is something for you, not something for the Fed, but we do see, and Fed research shows and other research shows, you do start to see longer-term negative effects on people who can't pay off their student loans, and it hurts their credit rating, and it impacts the entire path of their economic life.
So that's the public policy argument for us to do something about student loan debt and the way we structure higher education financing. My question for you is, do you see this as a macroeconomic risk?
It will over time. It's not something you can pick up in the data right now, but as this goes on and as student loan continues to grow and becomes larger and larger, then it absolutely could hold back growth.
Okay, thank you. And I want to thank you for your willingness to have an open mind on the question of the economic impacts of climate change. I appreciated your answers in the questions for the record, and so I'm glad you're willing to talk about it. Your position is that the Fed is only concerned with, and I'll quote, short and medium-term developments that may change materially over quarters and a relatively small number of years rather than the decades associated with the pace of climate change. Now, there are experts within the government that would strongly disagree that the problem of climate change is measured in decades. They would say we are seeing the economic impacts now. NOAA reported 16 separate billion-dollar climate events in 2017. Combined, these events cost the United States economy $300 billion, 1.5% of GDP. 2017 was a record-breaking year, but according to NOAA's science, it will get worse. The number and cost of these events has more than doubled over the last decade, and it has increased eightfold in the last 30 years. So I understand that your aperture is short and medium term. That is sort of a premise of how you operate. What I'm not accepting as a premise of how you operate is the assumption that climate change belongs in the long-term category, because I think you are analysts. You believe in data. And what I'd like for you to do is challenge that assumption that climate only belongs in the long-term category, because the federal government scientists are starting to indicate that that's not the case. So the question is, are you willing to relook at that basic assumption that climate is just outside of your window, to sit down with our office and with federal government researchers to at least examine the question of whether or not, as you do your planning, it continues to belong in this long-term category, which is outside of your aperture?
Senator, as we discussed in your office, I guess last fall, climate change is something that is entrusted to other agencies. We have particular responsibilities and particular tools, interest rates, supervision, looking out for the financial system. It's just not clear that it's really in our ambit as opposed to in the ambit of other parts of the government. So, but we're obviously always going to be willing to discuss it with you, but I don't know exactly how it would fit into what we do with our tools.
I guess the question, I mean, I understand what you're saying, but I'm trying to figure out why a 1.5% hit to GDP last year, and the agency that knows about such things is telling us to expect more and more of it, why that wouldn't be in your ambit. First time I've ever used that word.
Well, our ambit involves, moving interest rates up and down and supervising financial institutions. So I don't know. I'm not sure how it would enter into that.
Okay, I look forward to continuing the discussion. Thank you.
As do I. Thanks.
Senator Perdue.
Thank you, Mr. Chairman. I'm Googling ambit over here in the meantime. Sorry. Chairman, thank you for being here again. I have a question. You mentioned in your opening comments about that foreign demand for U.S. exports is up, and I happen to believe if we're going to be north of 3% GDP growth, we've got to grow our exports, and I think you've made those comments publicly as well. But the low interest rate environment of the last decade has shown a proliferation of new lending, or really a binge of new debt issuance in the third world, developing world, let's say that. And just this year alone, a lot of that short term. So this year alone, there's almost $2 trillion of that developing world debt coming due this year, and about 15% of that's denominated in U.S. dollars. Do you see that as we normalize rates here in the U.S., with the U.S. dynamics that we're talking about between inflation and unemployment, that the impact that could have on the developing world could, in effect, have some systemic risk on not only the global economy, but on our own recovery?
Senator, what we can do is we can be transparent, we can be predictable, and the markets can therefore understand what we're doing and be ready for it. And I think if we do that, we use our tools to achieve stable prices and maximum employment here in the United States and financial stability. And so what we try to do for the world financial markets is be really clear about what we're doing, predictable, transparent. As I look at the state of the emerging market countries and their financial markets and financial regulation, they're in a much better place than they were 10, 15 years ago, even 5 years ago. There's not as much dollar-denominated debt, foreign currency-denominated debt. They have better institutions. Not everywhere, but it's a much better picture than it was 20 years ago, let's say.
So following up on that, you talked earlier about reducing the size of your balance sheet, and that's been an ongoing effort even before you took office, as I understand it. So the question is, the four big central banks, China, Japan, U.S., and the EU, all have similar-sized balance sheets, somewhere between $4 and $5 trillion. As you normalize or as you begin to consider taking our balance sheet down to a more normal level, what actions do you monitor of these other central banks, or is it totally independent when you make those decisions?
Well, we monitor all financial conditions and economic conditions in our in what we do. The normalization plan that we adopted through the summer and then put into place in the fall has been accepted very well by the markets. There's no obvious reaction at all. It's a gradual decline. We've said we're not interested in deviating from that unless unusual circumstances arise. And I think that should be the path. And I think we get to a more normal balance sheet size within about 4 years, give or take a year, let's say. The other large central banks that are talking about normalizing their balance sheets, they're behind that schedule. Our economy recovered sooner. We're raising rates sooner. So, there's going to be it's not going to be a synchronized thing. It's going to be something that's happening more seriatim. So, but we'll be watching that very carefully. We're very mindful of the issue that you raise.
Good, thank you. One last question is a technical question, but it has to do with the leverage capital ratio. It requires banks to hold capital against all assets, regardless of the risk of those individual assets. In operation, it's created kind of a risk-blind rule, and I understand the overall rationale behind creating this risk-blind rule. But the question I have is ultimately, I have a hard time understanding why assets like Treasury securities and funds on deposit at the Federal Reserve are also in that calculation. Can you defend that and answer the question if you're reviewing that practice?
Sure. So my view is that the binding capital requirement should be the risk-based capital requirement, and that would take into account treasuries and reserves and how risky they are. The issue is that over time, banks have figured out ways to gain risk-based capital. So we want a hard backstop, and that hard backstop should be high and hard. It should be the leverage ratio. We don't want the leverage ratio to be the binding constraint most of the time, because that, frankly, encourages people to take more risk. If you're bound by the leverage ratio, it's really saying you could probably use some riskier assets. So we like leverage, particularly risk-based capital has been vastly improved since the crisis. So that's how we think about it.
So how would you view, right now in the few seconds we got left, just very quickly, what's your view of the general health of the entire banking industry in the United States, the capital formation arm of our economic effort in a free enterprise system? What is your assessment of the health of that industry today?
I think our banking system is quite healthy. I think we have high capital, high liquidity. We have banks that are much more aware of and capable of managing the risks that they face. They're much more ready to face failure if they do, because they have living wills. And I think we're seeing profitability. We're seeing returns on capital. And I think it's a good time in our system.
Right. Thank you, sir. Thank you, Mr. Chairman.
Senator Cortez Masto.
Thank you. Thank you, Ranking Member and Chair for this committee. And welcome, Chairman Powell. It's good to see you again. So I want to follow up on a conversation that you had with one of my colleagues, Senator Shelby, on the policy effectiveness and asset unit that you have created. Can you speak to how many people will work in the unit and how the importance of data will inform the decisions you make?
I think it's 5 or 6 people now. I don't know how big it'll be, but it's going to be something in that range, maybe a little bigger. But the idea is that we'll have a strong quantitative approach that's tightly focused on cost-benefit analysis. I would stress we already do cost-benefit analysis in everything we do, but we hear outside that there's interest in doing more of that, and we're actively pursuing it.
And the reason why you're doing this is so that it can inform your enforcement and policy decisions, correct?
Well, yes, and the calibration of our regulations. We want to be able to implement regulations in the least burdensome way we can, consistent with, safety and soundness.
And the data is key for your ability to do so, correct?
Very much so.
Yeah, and so I'm glad to hear you speak about the importance of data collection. I always support that, and it is critical to the work of the Federal Reserve. As I'm sure you're aware, the legislation that we've been talking about that's pending in the Senate, it would exempt 85% of depository institutions from full reporting of loan data under the Home Mortgage Disclosure Act. Can you speak to how this might impact the ability of the Federal Reserve to properly conduct its obligations under the Community Reinvestment Act, and whether the loss of this data might hinder CRA supervisory exams?
I'll be glad to. So as I understand it, CFPB writes the HMDA rules and regulations, and we use that data in what we do, in supervising the banks we supervise, which is a smaller group. In addition to that, sorry, I lost my train of thought. What Dodd-Frank did was that it took the base of historical data collection and it significantly increased that. So my understanding is that what's being looked at in the bill is to create a broader exemption just from the Dodd-Frank additions. And so I think we traditionally get almost everything we need from the historical data, and I think we can continue to work on that basis.
Right. And that's my concern, is the more data, the better. I mean, you're creating a data unit because data is key to your decision-making. My understanding is that the data that's used in the CRA supervisory exams seems to exclude relevant data points. Loans under $1 million are designated small business loans, even if they were not loans administered to small businesses. There's no analysis is made whatsoever of whether lending is occurring in communities of color, despite easy and accessible data via the Home Mortgage Disclosure Act. And so my question is, has the Fed considered broadening that criteria in its CRA supervisory exams? And what factors do you think would be helpful in determining whether small businesses, communities of color, and low-income areas are truly receiving the support that the law intended?
Are we still talking about HMDA data?
Correct.
So again, HMDA data is really an issue for the CFPB. They were given authority under Dodd-Frank to write the HMDA regulations, and we generally defer to them in terms of what their view is on that.
So you don't think that data is going to be informative in what you do with the Community Reinvestment Act and the oversight of that to ensure that that act is being enforced under the law to protect communities of color, to make sure there's no discrimination, to make sure that the loans are being sent to small businesses and ensure that the money gets where it needs to go? That data is not going to be helpful for you?
I don't say that it wouldn't be helpful. What I would say is that, first of all, that's an issue that the CFPB actually has the lead authority on. In addition, we will still have, my understanding is that we'll still have under this bill the information that we've traditionally relied upon for just about everything we do under HMDA. So we may not have the additional data from some institutions, but we think we'll be able to function.
Well, let me just tell you, and my time's running out, so I don't have enough time to ask the additional questions that I want to ask you. But let me just say this. As a former Attorney General in the state of Nevada, my concern was discrimination against certain communities of color in learning. And the reason why we increased that data criteria is to ensure there was no discrimination and ensure that the money was going to where it was supposed to be going under the Act and federal authorities. And so I don't understand, while we're rolling back that data and those data criteria, if you've said it yourself, to be better informed, you're creating a data a unit for analytical purposes to create and collect data. I mean, it informs us in everything we do. And so my concern is just that. How can we say we don't want the data when we know it informs every decision that we are making, particularly to ensure the money's going where it's going and there's no discrimination?
We've been talking about data. Let me take a step back and say that any kind of discrimination by race or gender or any other unfair basis in lending is completely unacceptable, and we are committed as an institution to finding it and using all of our tools to stop it.
Thank you. I know my time's run out. Thank you very much.
Senator Kennedy.
Thank you, Mr. Chairman. Good morning, Mr. Chairman.
Morning.
Do stock buybacks contribute to economic growth?
Well, if I can trace that out, when you buy back your stock, the money goes to the shareholder. They lose their stock. They can take that money and they do with it what they will. They can spend it. They can reinvest it. It doesn't disappear. So
Right.
there should be some effect. I've asked this question. It's essentially impossible to really track that on a micro basis, but I would think intuitively it would go back in the economy and either be spent or reinvested.
Well, if a company buys back its stock and the value of the stock goes up, then somebody has extra money, right?
That's right. There will be a wealth effect as well, as you point out.
And they could invest that money?
They could. They could spend it, invest it, and you're right, there would be a wealth effect from higher stock prices, too.
And the stock going up is better than the stock going down in terms of economic growth.
It is, although I'm a little hesitant. I would want to say that it's not our job, as you know, to
Right.
stop people from losing money or making money in the stock market.
Right. Last 60 days, bond market's been going down a little bit. What's that telling you?
Well, I think longer-term interest rates have been going up, and there are probably many reasons behind that, and I would just offer a couple. In my thinking, it's the expectation of higher growth. It's probably the expectation of inflation moving up a little bit closer to our target. It's probably also a realization that growth around the world is quite strong. So we've seen a strong recovery in continental Europe and in Asia, and so we're not the only game in town now. There are other. If money goes to other kinds of safe assets, that will tend to mean higher rates here. But these are all generally positive signs. So,
Could it be a sign of inflation?
it could be a sign of slightly higher inflation, and we seek slightly higher inflation. Inflation's been below our target since I joined the Fed almost 6 years ago.
You talked about us being at or near full employment. We're not at or near the optimum labor participation rate, though, are we?
The truth is we're not far from the longer-run trend. We have models that papers published 8 or 10 years ago, and they pretty much tell you that the labor force participation rate will be right about here. That's not really the answer to your question. Labor force participation by prime age males, for example, has been declining for 60 years. Mm-hmm. And there may be some good reasons for that, but there are a significant number of reasons that are not good reasons for that. So we as a country,
reasons for that?
So we may be on our longer run trend, but the trend is not a great trend. There are many prime age males and women out of the labor force whose lives would be better if they were in the labor force. And these are not. We don't have the tools to really address that, but it would be.
In 08, the labor force participation rate was a tad over 66%. Today, it's a tad over 62%. That's not good for the economy, right?
It would be great to have labor force participation at a higher level, as most advanced economy countries do. Our labor force participation rate is now, not even at the median of comparably wealthy countries.
And why is that?
It really is this trend of prime age workers leaving the labor force. A lot of them, that burden has been borne, as Senator Cotton was pointing out, by people with high school educations and below, the lower, less skilled and lower wage jobs. And it's been going on a long, long time. It's as I said, a 60-year decline.
But why, in your opinion?
I think it probably has to do with the evolution of technology. It certainly has to do with the flattening out in U.S. educational attainment. U.S. educational attainment went up for many, many years, and then it started flattening out in the 70s. And right about that time, U.S. wages flatten out, and labor force participation starts to get weak. So we kind of reached a point as a country where we couldn't increase educational attainment, and really many things started happening right about then. This stagnation of median incomes, for example.
If we could jack the rate up to pre-08 levels, that would be an enormous stimulus to the economy, would it not?
It would. And of course, there's an underlying trend, too, of the aging of the population. So older people, even though older people work more than they used to after the crisis, older people still work less than younger people. So as the population ages, that's why labor force participation goes down.
Thank you, Mr. Chairman.
25 basis
Thank you,
points
Mr.
each year.
Chairman.
Thank you,
sir.
Senator Warren.
Thank you, Mr. Chairman, and it's good to see you again, Chairman Powell. As you know, a few weeks ago, on Chair Yellen's last day in charge, the Fed issued a consent order against Wells Fargo prohibiting the bank from growing any larger until it made certain improvements. Now, the Fed also effectively forced Wells to remove an additional 4 board members this year. I've pushed the Fed for real accountability on Wells Fargo and its board for repeatedly cheating its customers. And I was glad to see the Fed take action. But I want to understand how the Fed intends to enforce the consent order now that you're in charge. The Fed requires Wells to submit 2 plans for approval by early April. One on improving the effectiveness of the board and one on improving the board's risk management practices. This is not clear from the order. Will the Fed Board of Governors vote on whether to accept these plans?
So we have delegated that approval to, I believe, to the head of supervision, but of course
to staff.
That will take place. I assure you that will take place in serious consultation with the board.
Consultation, but the board is not going to vote on this?
That's not the plan.
Well, you know, I don't understand this. The Fed has issued a major, unprecedented consent order against one of the biggest banks in the world, and the Fed board, the people who are actually appointed by the president and confirmed by the Senate, aren't going to vote on whether the order is actually being followed?
Well, of course, we did vote unanimously on
No,
the measures
it's whether or not the
themselves.
order is actually being followed, because that's the big question here. You know, in my view, staff is not good enough, Chairman Powell. Fed board members are supposed to make the big decisions, and Fed board members are supposed to be accountable for these decisions. Will you consider requiring a vote of the Fed board before these plans are approved?
Yes.
Good. Thank you. I appreciate it. The next step is that an independent third party must review Wells' implementation of these plans by the end of September. Will you commit to making that independent review public, redacting any confidential supervisory information that's necessary? I think the public deserves a chance to understand how Wells is working to fix the mistakes that it has committed.
I cannot make that commitment to you without discussing it with my colleagues and with staff who are implementing this thing. I will look into it. Yes.
Will you look into it? Will you urge your colleagues to consider making this public?
If it can be made public,
I'm fine about redacting confidential supervisory information, but my view here is that the American public, given all that Wells has done, the American public has a right to see it, and all of those Wells customers who were cheated have a right to see whether or not Wells is actually following through on its promises. You can see why some people might lack a little confidence in that.
right. So I will look at that, and if there's a way to do it that's faithful to our obligations and our practices, then.
Thank you. Good. And then lastly, the consent order says that the growth restriction remains in effect until Wells Fargo, quote, adopts and implements the plans that were approved by the Fed. So I want to be really clear on this. To lift the growth restriction, the Fed needs to see that the plans have been fully implemented, right? It's not enough that Wells has taken some preliminary steps toward implementing the plans. Is that right?
No, I don't think that is right. I think the thought was that once we've approved the plans and they begin to implement them, we see them on track, the growth restriction could then be addressed. No guarantee there, but we would then be prepared to look at it.
You know, I'm actually, then tell me, how much progress along that line is enough to remove the growth restriction?
Well, I think, again, we'll have to be happy with the plan itself. We'll have to be assured that the company has made these really significant measures and suffered a significant period of a growth cap. And, we will not lightly lift it, but I think that's our understanding of how we're going to do it.
The growth restriction is your really big stick here. And I hope that you won't consider lifting it just because Wells makes some marginal progress. Wells should fix its problems before it is permitted to grow any bigger. The consent order sent a powerful message to big banks that there could be real consequences, including consequences for senior officials if they break the law. But that message will be lost if the Fed does not enforce the order strictly and show the public and the banking industry that they mean business. Thank you. Thank you, Mr. Chairman.
Senator Tillis.
Thank you, Mr. Chairman. Chairman Powell, welcome. Thank you. And congratulations on your confirmation. Can you just explain, because I was watching a lot of the hearing in my office before I came up here, and you talked about global slack a couple of times. Can you explain to me what that really means?
The thought is that it has become, over the last 30, 40 years during our adult lifetime, possible to make just about anything, just about anywhere. Technology has enabled that, and rising living standards and capabilities in emerging market countries has created that opportunity. And the thought is that that capacity outside the United States is, in a sense, a form of slack, so that if you're, for example, a worker bargaining for higher wages, you're held back by this overhang of knowing that you can lose your job and that kind of thing. The issue is that globalization, most measures of globalization, sort of plateaued out about at the time of the crisis, and yet it doesn't. That story makes a lot of intuitive sense, but it doesn't actually link up very well with the path of wages over the past few years. So it's something we've looked at, and it gets written about a lot.
Actually, I think that's a very important point, because there's a lot of latent productivity that could be globally deployed, that as we talk about wages and we want to do a good job of moving wages in the right direction, they reach a certain point to where where we could plateau again, because that capability to deliver could go outside of our jurisdiction. I think it's a very important point. On productivity, a couple of years ago, I met with former Chair Greenspan, and he was talking about the one thing that he was most concerned with at this time was the kind of static growth and capital investment. And he was saying, a healthy percentage of GDP is somewhere around 8%, and we were trending down in the 4% range. Do you view that as a key indicator that we have to increase? And what, if any, trends are you seeing that give you some sense that we're getting to a healthy percentage of capital investment as a percentage of GDP?
We don't know how to predict productivity growth very well, but we do think it links up over time with things like investment in people, but also investment in plant and equipment, R&D, and that kind of thing. So, unfortunately, what the financial crisis did was it generated very weak demand conditions for a long time, and that created weak investment, and that itself then furthers weak demand. So it's kind of a bad self-reinforcing cycle that we had there for a while. That's why it is so heartening to see business investment moving up last year, and perhaps continuing a strong performance this year is our expectation. It is ultimately only productivity that raises living standards, and investment is one of the keys. Not just investment in plant and equipment, but certainly in the skills and aptitudes of our people as well.
Do you get a sense that what we've done with tax reform is a potential positive contributor to seeing that investment move up?
I do think it's a potential positive contributor in the sense that when you lower the corporate tax rate, you lower the user cost of capital. Like you, I've spent a lot of time working with private sector companies, and that's one of the factors they consider. It's not the only factor, but lower user cost of capital is something that should spur more investment over time, and that should add to productivity. Hard to quantify, but I think it's there.
And you and I talked about this once or twice in my office, and in my remaining time, I'd like for you to talk a little bit about the job that Mr. Quarles has, and post-crisis regulatory right-sizing. Be interested in your thoughts on Basel IV and regulatory tailoring. You know, and I know people ask you, I was watching in my office, the committee, I think some ask you about the banking regulatory reform bill that passed out of here, which provides some regulatory and I think responsible regulatory relief for a portion of our banking sector. But what more can we expect to see that are within your lanes and in your authorities on right-sizing regulations? The other thing I remember with Mr. Greenspan, he said the most troubling job creation growth that he saw was at that time, this was 2 or 3 years ago, post-crisis, about 300,000 jobs that have been created under the title of regulatory reform, which in my world, that's by definition a non-productive job. So I'm kind of curious to see how are we going to get to a more tailored, I think Senator Perdue asked this question, how are we going to get to a more tailored, more reasonable regulatory burden on this industry that still manages the risk that you have to be concerned with?
You know, I think our concern is to maintain and strengthen but make more efficient the big improvements we think we made after the crisis. That's higher capital, higher liquidity, stress testing, and resolution planning. And those are going to apply and continue to apply to the largest, most complex institutions in the strongest form. Our effort then is to tailor that at every level as we move down and make sure, and we did a lot of tailoring along the way, but we're now going back through each level to make sure that we got that tailoring just about right. Not everything that we need the 8 systemically important institutions to do needs to be done by every bank. And many of them have much simpler business models that are much more traditional banking, and a different regulatory strictures should apply to those companies. So it's something we're working on.
Mr. Chair, the only thing I would say, or Mr. Chairman, the only thing I would say is somebody who worked in a firm that helped prepare CCAR and stress test results, it still is unimaginable to me how a properly tailored environment could result in 60 and 100,000 page submissions. There's got to be a better way to do it, even at the high end of the spectrum, and I just look forward to you all continuing to look at it and manage the risk, but right-size it.
Senator Jones.
Mr. Chairman Powell, thank you for being here and welcome. I'd like to go back to a couple of questions. I think it's pretty obvious that folks on the committee are concerned about wage growth as in addition to unemployment. And you said in your testimony that with the economy growing the way it is, you expect to see wage growth continue, but that has been on a fairly modest trend over the last few years. Do you see that wage growth increasing over the next couple of years as opposed to the very modest trend that we've seen?
That is my expectation, Senator. As we've moved from 10% unemployment down to 4.1%, we've seen some gradual increase in wages, but frankly not what I would have seen. I think as you look back over the last 3 or 4 years, you can kind of tell the story about why that was the case. Now we're at 4.1% unemployment. Labor force participation is higher relative to trend than it was, and I guess I would have expected to see higher wages now, and I do continue to expect them to rise as the labor market continues to tighten.
Well, assuming the economy continues to grow as you expected, what are there factors that we need to be on the lookout for that could prevent that, the wage growth that you would anticipate as opposed to the very kind of, not flat, but very, very modest wage growth? Is there factors that we need to be concerned about or looking about in the future?
I think ultimately sustainable wage growth is a function of productivity. Wages should equal, inflation plus productivity. And so to get wages to go up sustainably over a long period of time, we need higher productivity. That's a function of investment in people, investment in plant and equipment, R&D, all those things that drive us to be more productive. That's really the only way to have sustainable wage growth is that.
Okay, well, that kind of leads me to another area, and I don't want to misrepresent your testimony the other day, so if I characterize something wrong, you just please tell me. It won't be the first time I've been told I'm wrong about things. But I think you said on Tuesday, to some extent, that limiting immigration could limit our productivity growth in the coming years. Chairman Yellen, your predecessor, also told this committee in the past that limits on immigration could limit GDP growth. And so without putting you on the spot to try to get you to wade into very specific hot-button issues that we've got here. Can you talk a little bit about why immigration may boost productivity and GDP growth?
So to go back to what I was saying, you can think of growth being a function of growth in the labor force plus productivity. Those are really the only two ways the economy can grow, is more hours worked and more output per hour. Now, if you look at our labor force growth, it used to be 2.5%, 25 years ago, 30 years ago. Now it's about 0.5% as the population ages, and some part of that 0.5% is immigration. So I think those of you who have the decision rights around immigration, this is a factor that you ought to consider. It doesn't directly affect productivity, but it affects potential growth through labor force.
All right. And I don't know if this would be an appropriate question, but is our current immigration policy contributing to, in any way, contributing to the lack of wage growth as you see it today?
Immigration is one of those issues that we don't really have authority over, and I can speak to it as it relates to things like potential growth, but I'm loath to get into current policy and things like that. I think I'll follow my predecessors in sticking to our knitting on that.
All right, I kind of thought that would be the answer, but I was going to ask anyway. Going back to wage growth, what can we do to, as wage growth continues, to try to decrease the disparities that women have in the labor force, that the minority population, whether they be Hispanic or the African American population, have in the labor force?
So any kind of discrimination in our society and our labor force is, of course, unacceptable and not something that we can tolerate. Having said that, we don't have the tools, broadly speaking, to address those things. The tools we do have, though, are the biggest thing we can do is to take seriously our statutory mandate of maximum employment. As you can see, when we go into recession, it is the most vulnerable populations whose unemployment rates go up the fastest and the highest, and you can see that they come down the most in the recovery. They tend to not get down as low as people with college degrees and things like that. But at the same time, that is really how we can contribute.
All right. Lastly, there was comments made in your testimony over on the House side concerning the appropriations process and potentially having Congress appropriate your budgets for non-supervisory type activities of the Fed. I'd like your quick opinion on that. And and how a potential government shutdown might affect that should you have that appropriations. I've been fairly critical of the way that the budgetary process here has been taking place. And so we've had we've had a couple of shutdowns in the last couple of weeks. How would that have affected your ability to supervise?
Legislatures all around the world, governments all around the world have seen fit to give central banks an independent source of funding. And I would say that that's a wise decision. The things that we do may not always be politically popular, and I think it's wise to give us just a little bit of degree of separation. Of course, we're transparent. Of course, we're accountable. And it's not just for monetary policy. Here in the United States, all three of the bank regulatory agencies have an independent source of funding. This is a decision for Congress that Congress has made for the last 40 years. It has not stopped Congress from providing, appropriate oversight of our activities and regulations. So I would just say that I don't see what problem we're solving here.
It seems to be working. If it's not broke, don't fix it. Correct. Thank you, Mr. Chairman. Appreciate that.
Thank you. And before I turn to Senator Moran, I would note to our members we have a series of 3 votes being started in about 5 or 6 minutes. And we have 4 speakers left here. If you are all very concise and stick to your 5 minutes, I think we can probably wrap this up at the tail end of the first vote and go over. So please pay attention to the clock for us. We won't be able to go over and come back because of the 3 votes. Senator Moran.
I'm glad I'm next, Mr. Chairman.
5 minutes.
Mr. Chairman, thank you. Thank you very much for joining us today. You're new at your job. I would tell you that listening to you in previous settings and today, you are reassuring, seemingly competent, Perhaps exactly the right thing we need at the Federal Reserve in today's economic and political world. So thank you very much for your service to the country. I hope I don't have to change my comments about you in the future. So we look forward to working with you. Let me go through three things. A Treasury report recently indicated that the current exposure method, CEM, may not appropriately measure the economic exposure of a listed options contract, and that a risk-adjusted approach for valuing options for purposes of capital rules, such as weighing the options by their delta, might be in order. I think this issue needs a quicker fix, and perhaps there's a long-term fix, but are you in a position to make the changes that you, at least at times, have said is important to make?
Yes, we are. We are, Senator. I think we're in the middle of a changeover from CEM to SACCR, which is the other way to do it, and we're also looking at the calibration of the enhanced leverage ratio. Both of those things should help.
What kind of time frame do you believe you're on?
I'd be loath to give you an exact date. Well, why don't we come back to your office on that? But this is an active thing, I think, fairly soon.
Very good. I would welcome the follow-through. Tomorrow I will meet with Esther George at the Kansas City Fed and look forward to that conversation. Part of what I will talk to her about is agriculture and particularly the rural economies of our region. Let me highlight for you something that I think is important for you in your regulatory role to remember. Farmers and ranchers often come to me and ask about the safety net that comes from a farm bill. Farm policies designed to help farmers and ranchers in difficult times, generally difficult economic times. We're experiencing those times now. The challenge is significant for someone trying to earn a living in agriculture. But there's a safety net that I think is often forgotten, and that is the relationship between the lender in their community, a relationship banker or financial institution, and that family farmer. And I just want to highlight once again the importance that we don't get to the circumstance in which the examiners, the regulations prohibit bankers from making decisions about lending or access to credit by agriculture based upon some very restrained, restrictive method. Let the issue of character, relationship, history between what's often a family-owned bank and a family farm continue. That is one of the most important safety nets in difficult times, is the relationship between our lenders and our bankers. And where I see the threat of that diminishing or being eliminated is through the regulatory process in which a bank is written up for making a decision that they feel comfortable with, but a regulator may not. Any response to that?
I'll just take that very much to heart, Senator.
Thank you very much. And then finally, let me ask a question about education. If we're looking for economic growth, it seems that a highly motivated, trained, and educated workforce is a significant component of that. Do you have in your understandings of the circumstance that we face in the employment market where we should be focusing our support for education, or where we should be emphasizing for students and adults? Those two things are not different. For those who need an education and additional training, where we ought to be focusing our resources to meet the economy's needs for that highly motivated, educated, and trained workforce?
You know, I'm probably not the right person to get down into the details of exactly where to focus. I will just say, though, that my view is that in the long run, the only way we can sort of win in the international competition is by having the best educated, most productive workforce in the world. There's really no way to hide from that requirement, and that's education. It's also training. It's not just college education. It's also, apprenticeship programs and that kind of thing, which are also can be very successful.
Tax rates are an important component in making business decisions, but the workforce, meeting workforce requirements is there as well. That true?
Yes.
Thank you. Mr. Chairman, thank you.
Thank you. Senator Warner.
Thank you, Mr. Chairman. Let the record show your timeliness of starting meetings meant that me being 6 minutes late really was
I noted that and felt bad for you the whole
quite a
time.
challenge. But I think it was, I wanted to stay because I want to ask the chairman two very important questions. Let me preface this by saying, in my first year here, one of the most important pieces of legislation I've ever worked on was the Dodd-Frank legislation. I think Dodd-Frank, for all its challenges, has made our system remarkably stronger. But we are 8 years later, and there are a broad bipartisan group of us who are going to debate on the floor next week legislation that would make some modifications. In this legislation, 2155, we have not changed the requirements that the Fed perform annual Dodd-Frank stress tests on banks above $250 billion. I think that's terribly important to maintain. We do give the Fed, after an appropriate period to do a rulemaking, the ability to look at those banks between $100 and $250 billion, and this is very important, to continue to undergo stress tests on a periodic basis. My view is that stress testing is the most important prudential standard, and that frequent stress tests are some of the best tools we have to prevent another financial crisis. Can you give us your views on stress testing, including how rigorous they should remain and how frequent they should remain on banks between $100 and $250 billion in assets if this legislation passes?
I'd be glad to. So let me just echo what you said. You know, we do believe that supervisory stress testing is probably the most successful regulatory innovation of the post-crisis era. We're strong believers in this tool, including for institutions of 100 to 250 billion. So it would be our intent, if this bill is enacted, to continue that these institutions would continue to have meaningful, strong, regular, periodic stress tests, frequent stress tests. And again, we see it as a very important tool for these institutions.
I hope again, folks who will be listening to this, we are not touching anything on the largest institutions on terms of the annual stress test on folks above 250. And as the chairman of the Fed has indicated, even amongst those banks between 100 and 250, we're still going to have frequent periodic stress tests that are still going to be strong. And the legislation lays out in some detail some of the requirements that we would have in those stress tests. My last question is this. In terms of overall enhanced prudential standards, we do move in this legislation from $50 billion to $100 billion. But we give you then, in the group of institutions between 100 and 250 billion, an 18-month period to essentially tailor those standards more appropriately. And as you've indicated, we already have an institution below $250 billion that still qualifies as a SIFI. So I would just like, again, for the record, for folks who are watching and who will watch the debate next week, that you will take this responsibility of this 18-month rulemaking and do a thorough examination of the banks that fall in that category, and those that are claiming that somehow all enhanced prudential regulations of banks that fall into that category are going to suddenly magically disappear, sure as heck is not the intent of this individual in terms of that legislation, and I hope is not the intent of the Fed.
What I see us doing is creating a framework. We'll be looking at all the institutions that are in that area and all the risks that might arise in banks between 250 and 100, and we'll create a framework for assessing where systemic risk might be, where there might be regional risks, and we'll look at everything. And that framework will then be in place in 18 months. And if there are institutions that are currently in that population or that over time become systemically risky or even risky to themselves, the way the legislation gives us a lot of flexibility to do that, then we'll have that in place. And as you pointed out, we haven't been shy about finding systemic risk under 250. We're perfectly happy to do that. So we'll feel comfortable doing this job, I believe.
Listen, I look forward to a fair and spirited debate next week. A lot of members have different views, but I think it's very, very important when people go about talking about doing away with stress tests or eliminating any kind of enhanced prudential regulations. That is not our intent. There may be some tailoring that goes on in this new category, but particularly for the larger institutions, status quo is going to remain. Thank you, Mr. Chairman.
Thank you. And Senator Heitkamp is next. I'll let our senators know we're 5 minutes on our way to the vote, so we've got to really go. Senator Heitkamp.
Thank you. I just want to follow up a little bit on HMDA and clarify what I wasn't able to attend because I had other hearings, but what I understand has been discussed is a clarification from you that nothing in this bill that will be debated next week undermines the Fed's ability to enforce fair lending laws. Is that correct, Mr. Chairman?
That's generally right. This is really, CFPB really writes these rules, and you should seek comment from them if you like.
I think that, but you would acknowledge that our bill preserves the traditional HMDA data collection on race.
It does, yes.
Yes. So while the bill doesn't undermine fair lending, it does meaningfully reduce substantial costs imposed on small lenders from HMDA data collections. I think this is the motivation. These costs can reach into the hundreds of thousands of dollars per year. One small institution estimates that the cost of HMDA quality assurance for their bank equals approximately $400,000 per year and involves 5 associates. So when it comes to regulation, we have to look at the benefits and the costs. And one of the things that I think I just want to impress on people is that when you don't respond to these kinds of concerns, legitimate concerns from small lenders, there's a resentment to the overall policy. That may, we tend to throw the baby out with the bathwater because of the level of frustration. Wouldn't you agree that we could, in fact, reduce costs to small lenders and still maintain the protections provided by HMDA?
Yes, I do agree.
Yeah. So when we're looking at going forward, I think it's important that we have a very spirited debate about this, but I think it also is very important that we put it in perspective and that we not exaggerate the results here or the purpose of this bill. And so, Chairman Powell, just one question, and I know you've been answering a lot of questions about the economy writ large, but wanted to just get your sense of economic growth. And as we look at, again, big surprise, I'm going to ask a question about trade. I know you guys don't always like answering those questions, but it seems to me that we're now looking at a potential of tariffs being imposed on aluminum and steel, for which there will be retaliation. We have, in fact, retreated somewhat from the commitments on NAFTA, and we no longer have a pathway into TPP. How concerned are you about the impacts of this trade policy of this administration on our opportunity for economic growth long term?
So I wouldn't comment directly on the administration's policies, but I will say about trade that I think that the record is clear that over long periods of time for many, many countries, trade is a net positive. It spreads productivity. It forces our companies to compete. It gives businesses and people the ability to buy and sell things in the world market. So overall, the studies all show, and theory would suggest that it's a good thing. But not all the benefits do not fall equally. There can be communities, there can be individuals who are negatively affected by trade, and we've seen a fair amount of that. I think it's more of that than probably was expected. And I think it's important that we address that as well, so that you can sustain a public support for trade. I think as Chairman Bernanke said, the tariff approach is not the best approach there. The best approach is to deal directly with the people who are affected rather than falling back on tariffs. But again, these are not measures that are consigned to us. They're really for you and for the administration.
But I think that these are measures that are going to have an effect on the kind of economic analysis that you do that's going to lead to monetary policy. I don't think there's any doubt that trade will have a dramatic impact on economic growth, and very, very concerned about making sure that our trade policy is consistent with economic growth, and also very concerned about the speed to which systems today can react to trade policy as opposed to maybe 20, 30 years ago when it was kind of, plodding along. It was okay if the WTO took 10 years. Today, I don't think that's true, and I don't think it's true that it's okay that it takes 10 years to get back into TPP. I think things will move a lot quicker, and it's going to have a dramatic effect on our ability to be competitive in this country and to encourage investment and growth. Thank you, Mr. Chairman.
Thank you, Senator Reid.
Well, thank you very much, Mr. Chairman. Thank you, Mr. Chairman, for being here today. And one of the things that we've noticed over the last many years is the decline in workforce participation of prime age men. In fact, the Kansas City Fed has done a lot of good analytical work on this. One reason is automation. Those are particularly the types of jobs, it seems, that are easily replaced by some type of technology, machines and computers, et cetera. As we go forward, I would assume that trend will continue, and it raises the question of how is the Fed planning to forecast these effects of automation with your mandate for full employment? We could find ourselves technically at full employment, but with millions of Americans who are out of luck and out of jobs, and technically not in the workforce. How are you going to deal with that?
The long history of this is, as I'm sure you know, technology comes in and it can displace people, but ultimately, if the people in society have the skills and aptitudes to benefit from technology, then the advent of technology lifts all boats. So for 200 years, really, since the Industrial Revolution, we've faced this problem, and over longer periods of time, it's always been the case that technology lifts all boats in a way. Now, I don't think there's any law of nature that says that has to continue, and the reason, so the part of it that we control is the skills and aptitude of our labor force. To the extent people have the skills and aptitudes to benefit from technology, to operate technology, then they'll benefit from it. And to the extent they don't, it's people with a high school degree and less who have really experienced the worst of this. That's where wages are low, that's where labor force participation is low, all those things. So it's a really easy thing to say and a really hard thing to do, but it comes down to education.
Do you think we're doing enough in terms of education, in terms of federal, state, local investment? I mean, we just saw West Virginia shut down for 2 days because their teachers felt they weren't being compensated well enough. And we have a situation, I think, in Oklahoma where they're only going to school 4 days a week because of budget problems. So I agree with you, education is the key. We don't seem to get that message.
There's nothing in the productivity data or any other economic data that suggests we are handling this problem well. All around the world, others are catching up and passing.
And exceeding us.
Yeah.
One other point, and this is one of a sort of passionate issue with me, that's the Military Lending Act. The Federal Reserve has a responsibility among many agencies to enforce it. The Department of Defense promulgated regulations in 2015, which I think are tougher. It essentially says you can't charge someone in uniform over 36% interest. That seems to me a pretty fair rule. And having just come back from Somalia and being with Special Forces people and their families back home, I think this has to be enforced aggressively. Can you tell me what you're doing to make sure that your responsibilities on this rule are vigorous and proactive and relentless?
We share your view about the importance and value of enforcing this, I assure you. And this is one where, as I think we've discussed, this is a very important regulation, and it will get aggressive enforcement from us.
And you'll get the message out to your regulated entities that this is really the top of your list.
Yes, we will.
Thank you, sir.
Thank you. Senator Van Hollen.
Thank you, Mr. Chairman, and welcome, Mr. Chairman. Good to have you here, the Banking Committee, in your official capacity. And I know there's been some discussion about stock buybacks. Stock buybacks are primarily a way for corporations to increase the share price. Isn't that right?
Yes. It works in that way, yes. Yeah. It's a way for companies to distribute cash to shareholders as well.
Exactly. So I do think it's worth pointing out that since the tax bill was passed, which was in large part advertised as a way to dramatically increase wages of workers. In fact, the predictions were $4,000 a year pay increases. We've seen the overwhelming amount of the money that's gone to corporations used for stock buybacks. In fact, $200 billion of stock buybacks just in the first 2 months of this year alone, including $20 billion stock buyback from Wells Fargo, a major financial institution that we've had a lot of discussion about in this committee, primarily because of violation of consumer protection issues. I do think it's also worth pointing out that over 35% of the stock owned is actually owned by foreigners and foreign entities, which is why the Prime Minister of Norway, when she visited a short time ago, thanked President Trump for the tax bill because it dramatically boosted the stock value of the Norwegian government and its holdings. But it means money not going into the economy, generally speaking, direct investment by those corporations. I wanted to ask you about the issue of cybersecurity and the impact of cyber attacks on our overall economy. We've seen big banks that have been victims of cyber attacks like J.P. Morgan. I believe the Fed in the past has been the victim of some cyber intrusions. And the Council for Economic Advisors just put out a report indicating that malicious cyber activity cost the economy between $57 billion and $109 billion in 2016, a big number. And the chairman of the committee has spent a lot of time focusing on this issue, and we had a hearing specifically on the Equifax breach. This evening, I'm going to be teaming up with our Maryland State Attorney General, Brian Frosch, to have a forum on consumer protection. 700 people have already signed up for this, and we expect many of them to have been victims of the Equifax breach. My understanding, there's been reporting, first of all, just this morning, that the Equifax found an additional 2.4 million people impacted by the breach. And there was also a February 4th report saying that U.S. consumer protection official puts Equifax probe on ice. And the article says that the CFPB, under the leadership of Mr. Mulvaney, has, quote, rebuffed bank regulators at the Federal Reserve, the FDIC, and the OCC when they offered to help with on-site exams of credit bureaus in connection with the Equifax investigation. Can you confirm whether or not the Consumer Financial Protection Bureau has rebuffed offers by the Fed to help them get to the bottom of the Equifax?
No, I can't. I hadn't heard that.
If you could get back to us, I mean, this is a publicly reported document. Would you be willing to get back to us and let us confirm or say one way or another?
Sure.
I appreciate that very much. In terms of the impact on banks, you have the direct impact. Banks are also impacted when those that have less cyber protections, Target, for example, are hacked. And as a result of that, the banks have to pay the credit card costs directly to consumers. And then they got to go recoup that money from other entities. And so one of the things I've been focused on and the committee's talked about is to try to get the SEC to increase its oversight with respect to cyber attacks, and especially their responsibilities to disclose to the public in a timely manner. And I would just ask you if you could work with us and the other regulators in trying to come up with disclosure requirements that provide the public with adequate notice of these cyber breaches so they can protect themselves from the cost, not just the public, but banks and others as well. I would appreciate that if you could do that, Mr. Chairman. Thank you.
Thanks.
Thank you. And Chairman Powell, Senator Brown has said he has
I will be very brief. Respecting your time and our getting to the vote. I heard you say a number of times in response to questions there'll be no relaxing of the rules for foreign banks, and I want to I just don't agree with that. A Treasury report last year, the administration made it clear it wanted to lower standards. Secretary Mnuchin testified, sitting where you are right now. In January, they believed the bill would accomplish the goal. Paul Volcker has said it does. Sarah Bloom Raskin said that there will be less regulation of the foreign banks. Antonio Weiss said the same. I had an amendment during the markup on that issue, and it was defeated. Foreign banks lobbied against that amendment. The bill's supporters rejected it. I have three very related questions. I'll ask them three consecutively, and if you don't, either answer them now or get them in writing, if you would, to me. Promises she'll push back against foreign bank lobbyists and Secretary Mnuchin to ensure that no foreign bank with more than $50 billion in U.S. assets will benefit from any deregulation. I would like that promise from you that you will push back against foreign bank lobbyists and Secretary Mnuchin. I'd like to know what you plan to do when a foreign bank sues the Fed for not treating it equally to a U.S.-based bank that fall in that 50 to 250 category. And I guess my final question, wouldn't it be better to amend this bill to avoid litigation, make sure it does not benefit large foreign banks? So either if you want to respond now or you can respond in writing soon.
Well, why don't we take those under advisement and give you a clear response in writing quickly.
Fair enough. Okay, thank you, Mr. Chairman.
All right, thank you. And that does conclude the questioning. Again, I want to thank you, Chairman Powell, for being here and for the service you are giving to our country. For senators who wish to submit questions for the record, those questions are due on Thursday, March 8th, and I encourage you, Chairman Powell, as if you receive additional questions, to respond to them promptly. I also apologize that because of the pressure we have on the vote, I'm going to have to conclude this hearing and then run to the floor, so I won't be able to visit with you privately or more personally after your testimony, but we will have plenty of opportunities to do so. So with that, the hearing is adjourned.
Thank you, Mr. Chairman.